filing in here. We'll take a break for Q&A in a moment, but I do want to cover today's trade alert before these prices get away from us. We're already up in our portfolio from putting it on 20 minutes ago.
You are live.
Okay, guys, welcome to your April 27th live trading webinar. Today we're adding 200 puts on the VXX is the product we're playing. And there's 2 strikes, 100 at each strike. This is for 5/8/2020 and 5/15/2020. These are out of the money put options and represent just over 1% total portfolio. Here's the trade alert to be written out clearly is again to buy the 30 VXX put and the 28 VXX put, 100 shares, 100 contracts per $75,000. So in a $1.5 million portfolio that we're managing, that's 2,000 puts at each strike. So these are costing somewhere between 8 to 10 cents this morning. And that price is going up as VIX is collapsing. So we'll take a look at what's happening in the markets in a moment. But first, let's make sure everybody understands the current trade that we've just put out. Okay, so let's review through the entire trade alert from head to toe, and I'll be keeping an eye on any questions. But the big addition today is, again, these out of the money put options on VXX. So the trade alert document, let's go from head to toe. And again, we're looking for one last pop in the stock market. The Fed has cut quantitative easing significantly week over week. In fact, the teaser I sent out was actually incorrect. They didn't drop it from $50 to $25 billion a day of QE. They've dropped it to $18 billion a day of QE. Yes, we do. So this is a hedge, Jeff, and I think we're going to crash after we fix the oil problem and get another big pop in the stock market. Now, there's always the risk that doesn't happen. So we're perfectly positioned for a crash at any moment. But again, we have 2 hedges now, really 4 hedges now against any upside risk. So let's take a look at the total portfolio. If you're a new member today, you have a lot of work to get done. If you're an existing member, all you have today is to put on those 2 new put options. So let's go through the trade alert head to toe, and we'll make sure we're all clear on what to do. So currently, we have per $75,000, 2 new trades today. This is, again, the 2 VXX put options that are out of the money, and that's been ranging between 8 and 11 cents this morning. Actually, when I first started writing the trade document, we were at 7 cents. So that position is already rising. The next part of the portfolio is to have 200 shares of the TLT ETF, and that's, again, per $75,000 in our portfolio. 400 shares of GDX. This is another hedge against upside risk. Gold market's highly correlated to the stock market. And again, it comes with the married put. So we'll go over the put options in a moment. The next big play is the USO, 2,000 shares of USO per $75,000. And again, this is also protected with a put. So this trade's actually, although we see USO going lower, when we look at the future contracts, we're seeing that spread reduce. And that's really what we want to see. I'm looking at some questions. Ignacio saying the Bark in the TD Ameritrade, this is VXX. So if you guys have trouble finding that, let me know. The next part of the trade is to buy to open the 6/30/2020 220 QQQ call option. This is another upside hedge. Moving along, we have a set of put options, which I have a hold on and a not enter order for today. So if you have these puts, stay put, no change. If you're new, we're going to wait until this Friday to put this position on. So we have a lot of interesting things happening this week. The Fed has an announcement Wednesday. People are speculating if they'll go to negative interest rates. I would suspect not. And then we have lots of earnings coming out this week, including Microsoft, Apple, and Google. The next set of our positions is these TLT call option and put options. The 162 put we roll every Thursday, and this gives us downside protection on the TLT. And then we have this set of call options, which are still a buy. And again, these are two of these are in the money. One is just above the money. And this gives us a little extra leverage on our favorite position, which is the US Treasury market. Now, to protect your GDX positions, we have the 8/21/2020 $28 GDX put, and that's 4 per $75,000. So in general, we have a put option underneath each asset, and this allows us to safely buy these and not have to worry about downside risk. So if you have the $23 GDX put, that's still a hold. But if you're new, we're not picking up that put option today. Then finally, to protect your USO position, we have the in the money 250 put option. So that's 20 put options to protect your 2,000 shares. William says, are we buying 100 contracts of VXX per 75,000? No, we're buying the put option on VXX, and that's, let's go back up to that trade. So these are coming in at 10 cents or $10 a contract currently. So it's about $1,000 per position per 75,000 invested. Okay, continuing on in the trade alert, the next position we have is the emerging markets put. We're currently holding that. It's not a buy today. But if you are a new member, we have a replacement trade, which is the 11/20 2020 31 FXI put. So this is again based on per $75,000. David says, would you suggest buying any of these options without currently being invested in the corresponding stock? Yeah, the entire portfolio is a entire strategy, David. So it really makes sense to build the entire thing as it works as a correlated strategy. And if you cherry pick parts of it, you may get lucky, you may not, but it's really designed to work as one overall strategy and not a piecemeal strategy. What to expect? I think we have a small amount of upside ahead. The main catalyst I'm looking at is fixing the oil problem while there's still a little bit of quantitative easing happening. We have the Bank of Japan sort of taking the baton from the US in terms of quantitative easing, but they're not directly putting those assets into our markets. So the key for us was predicting that the quantitative easing would come to an end, and that is happening. We went from $25 billion a day of treasury purchases last week to $10 billion a day this week. On the mortgage-backed securities, they were buying similar amount of mortgages last week, and now they've dropped that to only $8 billion a day. So the only other lines of credit that we have to keep a close eye on are the Forex lines of credit we're providing to countries. Yeah, William, that's 100 put option contracts for about $1,000 at the current prices. So it's an out of the money put option at 2 different strikes. Okay, so what to expect? We have a couple catalysts that can keep the market moving higher. Probably the last set of earnings that will look half decent are coming out this upcoming weeks. Like I said, the oil problem is likely resolved in the next 2 weeks, which could be a big cheerleading event. And then, of course, we're seeing states slowly but surely relax lockdown restrictions. So all of this combined, I do think, can give us one more push to the upside. On the other hand, we have a lot of economic data that's going to be quite terrifying, and we're having the Fed remove the liquidity from the markets. So I do think this is going to be a short-lived final pump in the markets. And that's why we have, again, a handful of positions that protects us against the bigger risk in the market, which is a stock crash. So what to expect at the next big pullback in the markets? Will be releasing our TLT call options, a portion of our SPY puts, our USO puts, if indeed USO is not fixed by the time we do have a sell-off. Our GDX puts will be released at this time, our FXI puts, emerging market puts, and I believe this timing will be sometime around late summer. Now, the intention is to rotate into a sequence of ETFs that will benefit from all the government stimulus, which is now at $2.6 trillion of newly promised money that's being printed out of thin air currently and will end up in the treasuries auctions coming up. So those ETFs that we're looking at picking up are XLV, the healthcare ETF, biotech, IBB, medical devices, IHI, e-commerce, ONLN, and then aero defense, ITA. Now, if we look at our returns so far, we're essentially flat in our pro return with the boot camps. We're outperforming the S&P 500. The sharp rally in the equity market has had a little bit of a dent in our returns this year, but the big picture remains exactly the same. Extremely confident in our positioning and just using a small amount of hedges here that are leveraged to help everybody stay confident while we wait for the bigger move and the big picture to develop. If you're doing the pro return without the bonus trades in the boot camp, you're about 1.5% behind the rest of our group. Not bad. Our basic membership does have some drawdown at -8%, but again, that's primarily from our long put options that cover 2 years of downside risk protection. So if you did cost average that out over a period of 2 years, it's really not that big of a deal. In the buy and hold, you have a similar drawdown, a little bit less, and no changes outside of one announcement. Now, normally in our buy and hold portfolio, I'm not giving out option trades. If you are able to take options, this is a recommendation to buy 2 puts on the VXX per $1,000 following the program. It's really the most beautiful way to protect your very bearish portfolio that we currently have in the buy and hold. Now, there's one other change to note, that Tex had a reverse split 10-1, so I have reduced that down to 1 share of Tex. So no changes in your positioning, although the split we had before is not exactly equal to this reduction, as it would be indicating a half a share of Tex. So this is the current balancing recommended. 1 share of Tex, 1 share of the inverse bank ETF FAS, 2 shares of Yang, 3 shares of the TLT ETF, 5 shares of GDX, and then you have about $166 currently in cash. Jack is saying that he's showing the cost of the option. Are you looking in Robinhood right now, Jack? Let's see what it's reporting on my end. So I see it coming in at 12 cents currently. And this has been rising all morning. When I was writing the trade alert, we were at 7 cents. Ron says on the buy and hold would be that 2 of each or 1 of each? 2 of each. Great question. So yeah, if the volatility index really collapses over the next couple weeks, these can easily return a very massive gain with low risk. So I think this is a very short-term opportunity, especially correlated to the oil situation being fixed at this point in time. Is everybody getting their put options filled? And Jack, that's odd. Yeah, I think it's time to get out of Robinhood. I think you're going to do better at either Interactive Brokers or TD Ameritrade. That's really a bad price that you're showing.
Hey, Jack, and just make sure to double check your strike and your time. I think that might be off actually. So just make sure to reread the trade alert and just make sure you have the right strikes and prices.
Okay, David says he's having trouble with that 28 put. Are you doing a limit order or market order? Which broker, David? But yeah, let's just take a look at all the trades we have, and I'll go over what the expectations are, and then we'll jump into more content. So the TLT is our favorite position. The TLT product plays a 30-year treasury, and really what we want for that is the expectation of David's trying to do a Robinhood limit order. Oh boy, another, yes. So you're going to want to do, if you can, a market order to get filled much quicker. And I would bid closer to the ask instead of the bid. So go for the higher price between the bid and the spread. Okay, so if we're playing the bond market, we want to expect the government's going to blow out its deficit and grow it at a fast pace. Current estimates were going from $1 trillion deficit last year to $3 trillion this year. So probably we'll see 2 to 3 trillion of that sold in the coming months, and then that will likely grow again next year. So my expectation is a 2-year acceleration of debt, which again forces yields lower, and is why we have so much of our capital allocated in the TLT ETF. We'll take a look at that in the very near future. Gold is a upside hedge. I do expect the GDX ETF to tank alongside the stock market, but the big thing is we need the central banks to switch gears from quantitative easing to allowing their governments to go sell these deficits. The mechanism for them to do that is to stop doing QE, which again puts the market in a tough spot. As everyone knows, without intervention, these yields would spike and crash the stock market. So with intervention, all the central banks know to buy up the treasuries, hold, and then get quantitative easing after the reason all the deficit's been issued is Jack, no, the price is a lot lower than that. So they may be giving you a bad price over at Robinhood. What is everybody getting filled at currently? If you could post your prices. The next play we have is USO, and this is a short-term hit. I believe that the government's going to come in and bail out the oil companies, which can be a few things that happen for this to really play off. Number one, we want the long-term outlook for oil to continue to be diminished. Okay, it looks like people are getting filled from anywhere from 11 cents to 15 cents. Those are all fine fills. Our hope is to let go of this for somewhere between 50 cents and $1.50. So it's a low percentage of our portfolio and can have a huge return in the coming weeks if we do get another pump in the stock market. And if we don't, we're perfectly positioned with a host of put options and the TLT. Mike's having a hard time getting his position filled. Maybe break it into smaller orders, Mike. DD says both her calls and puts are rising. That's great. So what's coming down the pipeline for oil? I believe that we're going to see a lot of oil drillers go bankrupt, stop mining, rather drilling. At the same time, the US is likely going to bail out the big oil companies and pay them to sit on their hands, as well as potentially create new storage space. So the basic bet for USO is the short-term outlook for oil spikes, but we want the long-term outlook to remain subdued. So with the Saudis having oil tankers floating all over the oceans, really at the coast of California, there's a ton of them over by Singapore. They're flooding the market, and this does make this outlook get better by the day. And so again, it's really once the short-term price, spikes above the longer term price, you're going to see USO jump. So that is happening right now. Boris says, I am new. What makes you think the stock market is going lower? Yeah, so we're seeing GDP prints around the globe of -5 to 10%. Profits and earnings are going to be collapsing, and we're not going to be back to a normal economy probably for 1 to 2 years. So this is going to be, we got unemployment spiking at Great Depression levels. So basically the prediction is that earnings this year and next will be much less than last year. And at the same time, the government's deficit will be growing at a rapid pace. And so it's really when the government has to sell that deficit, it's going to become a magnet for all the capital in the world. And that's what's quite likely going to really give us the biggest crash we've seen in our lifetimes. So we'll go over that in great detail, Boris. For now, let me just make sure we got the trade alert clearly outlined, and then we'll cover the analysis behind that. Okay, so the TLT again is our favorite pick. If you think the government's going to expand debt, you want to be long the TLT, and this is without question happening. GDX makes a lot of sense with the countries around the world printing at rapid pace, but that's coming to an end right now, and the next move is quite likely down with stocks. That's why we have the put option protecting GDX. USO is a futures product, and again, it's not what you normally think. We really want the long-term outlook of oil to remain suppressed, which is almost without question the foreseeable future for oil. And we want some short-term outlooks for oil to make the front month of WTI spike. And so we've been watching that spread collapse. And as soon as they cross over, we can see a big jump in USO. That'll be our trigger to get out. And what I also believe will be the catalyst to give us the next jump in the stock market. So if we do see USO pop, I'll be selling it, and at the same time getting off these VXX puts and the QQQ call. So I do think that's the last big thing we have going our way for the stock market, because the Fed's ending the liquidity supply. Okay, Jim got filled. Very good. The QQQ again is a upside hedge. I don't believe the stock market will be heading higher for very much longer, but this does give us quite a bit of time to catch the next big jump. And I do intend to sell this after we go well above 220 on the QQQ. So we entered this on Friday, I think at 210. So we're about 25% of the move up on the QQQ before I would want to pull that. And my target's around 230 on that QQQ. The VXX puts, again, will be selling likely this Friday. The next one, the 5/8, either this Friday, probably this Friday. And then the 5/15 we'll hold on to for an extra week. Mike's still having a hard time getting filled. Yeah, I think I would do batches of maybe 500 at a time, Mike. And I would just do market orders, guys. This is a very leveraged trade that, you know, again, we're looking for a sell order around 50 cents to $1.50. Okay, Murray got filled. Very good, Murray. And Murray's trading $1.5 million, so that's a lot of contracts he got filled there. Ram says hi. How's it going, Ram? Now our puts, let me talk about our intentions for this. I expect that this Friday we will readjust these and be doing two things. We're going to extend the duration and we're going to move the strikes up considerably. And then we'll be able to sit back on this position and wait. So that's what I have coming. I'm not selling the position. If we do get something unexpected this week, this is a once in a lifetime, once in a history economic collapse we're facing. And so it's not worth it to sell these and not have that exposure, even though we anticipate readjusting it this Friday. So I am getting ready to readjust that, and we can sit back. Expect to see these strikes move up by $50 to $70 and to extend the duration by 2 to 3 months. So this will likely turn into this duration and be pushed up between $50 to $70. Ernest says apparently Tastyworks has a limit of 250 options per order and 500 as a position. Yeah, so you can get the same effect, Ernest, by getting a few strikes. And even if you had to, getting a few different expiration dates. Essentially, I'm expecting the risk of a collapse in volatility going into the next several weeks. Okay, moving along the TLT positions. This can do well even if the stock market doesn't crash. We've been watching it go up with stocks, which is highly unusual and really tells you that this rally is just central banks propping the market higher. It's not a real market where people are selling treasuries and buying stocks because these two really don't go up together unless you have extreme manipulation. So again, I do expect us to begin selling these TLT calls in tandem with the next leg down. So these are a great position you can build today and expect to, again, roll that 162 TLT put every Thursday. GDX, again, we're doing the married put. This is allowing us to get into the position early. If there's a rare thing in history where GDX loses its correlation to the stock market, we only need to pay off the put to drive profits. On the other hand, if GDX does crash with the stock market, we won't care because we have that $28 put, which we can sell for a profit and remain long these critical positions. And I'll take a look at what I think is happening in the gold market, what our timing will look like on that. USO, to reiterate, you have the in the money put at 250. So per 2,000 shares of USO, you're buying 20 $2.50 puts. That's in the money. This means that you're going to realize your biggest loss possible on USO the minute you place your trade. You can't lose a penny more than the cost of your put option, and realize that your put option is 35 cents in the money. So whatever you pay for your put, reduce that by 35 cents, and that's your greatest risk on this position. And again, I'm expecting the American government to step in and create a spike in the front month of the WTI price. At the same time, the long-term outlook for oil looks bleak, and that's how we can get a big jump in USO. So we have until January 15th for this to occur, but the reality is they need to step in and intervene in this market within the next 30 days. Otherwise, I do believe this in itself can create the next leg down in the stock market. So a lot of these act as high return hedges. For USO, I think we can get out between $7 and $10 a share. If we go below $1, I'll be very tempted to sell my put and remain long the same shares I have held. The FXI position is anticipating that the US-China relationship is going to deteriorate going into the election period, and that there's a risk that we could actually begin creating capital flows to Chinese ETFs. So this is a hosted product on the American exchange, but it gives you access to Chinese companies which do not perform audits. And that's probably going to be the big sticking point that allow us to start creating capital flow restrictions to Chinese related ETF products. So FXI The cost on that put's probably below $1 now. I'll have to double check. So that's really your risk. Our hope is that they literally delist FXI altogether, and then you'll get $30 versus the dollar you paid for your put. So that has a potential 30-to-1 return. Now, even if they don't delist Chinese ETFs, there's also a high likelihood of a stock crash going into the election. And again, that $31 put is about halfway where I believe FXI could trade to. So we'd be looking to sell that after FXI was trading somewhere around $25 or below. So total allocation is less than 80%. We have a few very leveraged bets to the upside, and then we have a lot safer long-term bets with more duration and protection betting on slowed economic growth and bad times ahead for the stock market. So currently, you should have less than 80% of your portfolio allocated and 20% in cash if you're building this entire portfolio out today. Mark Stoley says SEC is already giving out warnings about the lack of audits for Chinese stocks. Yeah, for sure. Randy says, do you know there will be a reverse split on USO? Yes, I do. And they're actually going to make the put options work out fine with that. So I think we'll have no changes in USO to deal with the reverse split. So no changes there. You should be just perfectly fine with the current allocations. So we'll review that and see if there's anything that's not protected after they do that split. But again, I don't anticipate us having any changes on USO. And again, if you're in the buy and hold portfolio, no changes for you. They did do the 10-to-1 split on tech, so I've adjusted that from 6-to-1. So it's a slightly bigger position for new members joining today. I didn't actually change my buy and hold portfolio, but I did add the 2 puts per strike to give this portfolio a little extra hedge while we wait for really the inevitable. Okay, great. So let's go ahead and take a quick look at some of the top news today. And we'll take a break at the 1 o'clock Eastern mark to review our program options for new members, and then dive into a lot more news after that. Okay, so let's start off by going to the webinar teaser today. This is really the big risk. And so we're seeing civil unrest. We're getting mixed data. Some areas, it looks like the cause for our economic turmoil is extremely dangerous, high mortality rates. But then you get data coming out from prisons that would make you think this is a completely harmless virus that's spreading. So there's a lot of mixed information coming out. And I'm going to try to do my best to make heads or tails out of that for you today. But this is really the big risk, and I'm quite sure this is going to play out regardless of exactly how dangerous the virus is. This is the Spanish flu. They did the same mistake that we're making, and perhaps just because the economy can't afford to remain shut down, but they started to see the flu pick up, went into lots of lockdowns, restrictions, made wearing a mask a law. And then after they thought they had it beat, they'd flattened the curve. They went back to life as normal. And then about 6 months later, the Spanish flu really came in. And this is deaths per 1,000 people. So you can see 2.5% of the population passed away during this period of time. And they actually ended up with 3 waves before they were able to beat the Spanish flu. So my summary was that the states are beginning to reopen their economies as civil unrest rises by the day, accompanied by anecdotal data suggesting the virus is already widespread and not as dangerous as originally thought. So we'll look at the reporting. I could convince you either way. If I had a one-minded view of what's going on, I could convince you this is really in-game, extremely dangerous. But I could also show you plenty of data that make you think this is completely overdone and widespread. So we'll try to make heads or tails out of that. But meanwhile, really the person who I think you should focus on for future predictions is Bill Gates. Now he's been going all in on a vaccine, funding just about every big company under the sun who's trying to create a vaccine, as he continues to do interviews on left-siding media, including BBC, TED Talks, and just yesterday, CNN, where he painted a rather bleak picture of the next 24 months. So Bill Gates does not think this is coming to an end. Now, on his recent interview with CNN, he was critiquing the American government and really applauding the Chinese, while also really giving more and more support to the WHO. So that's quite alarming. And we'll spend more and more time really investigating what's going on with that. But I unfortunately do think he quite likely has the best intelligence and prediction capacity at this point in time, even if we perhaps don't like what his intentions and goals are, which is clearly that he wants to sell vaccines to world governments and force this on 7.5 billion people. So that's alarming. More importantly, in the short term, for our portfolio, is that the Fed has dropped quantitative easing purchases from 50 billion down to, and this is actually a typo, this is actually down to 18 billion a day. So they have been dramatically ending QE, which we anticipated. And that means stock market's going to run out of free money. Everybody's going to be buying up treasuries for the buy and hold. Jerry says population control. Yeah, well, we know Bill Gates thinks there's too many people and that we're going to pollute the planet and that the world would be better with less humans. So, if you take out the emotional factor and pretend you're not a human, I guess you could say that, we are the virus eating up and gobbling up the planet. And now we're the food for a new virus to gobble us up. What else is happening this week? We have two big events. We have really key companies that are supporting the stock market, Google, Apple, Microsoft, reporting. And then, and this is probably their last decent earnings that they're going to report for years. But beyond that, we have the Fed's policy announcement this Wednesday. I expect them to make no changes, but we'll see. Are they going to dabble in negative rates? I don't think so, because we're not seeing other central banks drop their rates at this point in time, although the Bank of Japan did indicate that they'd be willing to go into negative territory. So that's some of the big events coming up this week. Now let's jump into some news. We'll just cover some Twitter highlights to begin, and that'll probably take us to the breaking point to review our products, and then we'll dive into more information right after that. Okay, so let's just see some of the top headlines this morning. President says, why should the people and taxpayers of America be bailing out poorly run states like Illinois and cities, in all cases, Democrat run and managed, when most of the other states are not looking for a bailout help? I'm open to discussing anything, but just asking. And then Hipster replied, why should we be bailing out poorly run companies? Key events of the coming huge week. So again, we've covered this, but we have the FOMC rate decision. I believe that there'll be no change. And then we have a lot of GDP data coming out all over the world, inflation data, which I believe will be low. Hedge funds are getting bullish on WTI despite storage fears. Brent June, July contango narrowed from negative 350 to 327, week ending of April 24th. So again, what we really want is the front month of WTI to spike while the future months reduce. And so in this picture, what you can see is the spread has been tightening. And so we want those to cross over, and that's where you get your big pop in USO. So far that trade's looking very good. I know the price doesn't look like that, but it's really, once this switches, once it crosses, that's what's going to give us the pop. U.S. House Speaker Pelosi says the idea of a minimum guaranteed income may be worthy of attention. Stephen Heinrich, here it comes, first corporate socialism, then full socialism. The problem with this is, again, are you going to make people not want to work? So a lot of companies are trying to open back up, but people don't want to go back to work because they're getting paid so much to be on unemployment. Bank of Japan will not rule out deepening negative interest rates. Okay, so that's really key. We do want to see some of the smaller central banks push lower and lower rates, which would give us confidence that the TLT can continue to rise further and further, which is almost guaranteed to happen. If it doesn't happen, there's no way we're going to sling the $3 trillion deficit this year. The WHO said on Saturday, so the WHO has really flipped gears. They went from telling us there's no human to human transmission in January, when clearly Bill Gates, China, the CIA, everybody knew this was transmitting human to human. Way back in December, we knew this. Everyone knew this. So it's quite interesting to see the tone suddenly change. So they were telling everybody not to stop travel, not to do anything, almost as though they wanted this to spread like wildfire. And now they're putting out data to scare people. So here's their latest. The World Health Organization said on Saturday there is currently no evidence that people have recovered from the virus and have antibodies or protected from a second infection. So in South Korea, for example, they're seeing something like 2.5% of the population who had contracted the virus and had beat it and had created antibodies are now coming back and are being reinfected. So it's really not enough data to understand how or why. And we really don't know what the long-lasting ramifications of catching this are. Is this something you'll have to deal with for the rest of your life? Or is it more like a flu? You get it once, you beat it, and then you just get worried about the new strain of it hitting you the next year. Chinese propaganda. The U.S. wants to restart the economy when the epidemic has only slightly eased. Greedy businesses, helpless workers, and ambitious politicians are creating a courage with which more people could be sacrificed. Humanity will survive the pandemic, but China and the U.S. are taking different paths. And that path is to decouple. That's really the big picture, that the U.S. and China are having an ugly divorce, and now they're fighting over how that breakup is going to happen. So that's really the big picture of what's coming down the pipeline. And this in itself will really be awful for global economic data for the foreseeable future. Okay, this is just a joke. Maybe it's time to end the lockdowns. And even though they're saying they're ending these lockdowns, it's very, very restricted still. So the chances of the economy performing anywhere near what we had in the past is zilch. But again, I think between fixing the oil problem, the Fed keeping rates at zero, and doing some quantitative easing this week and next, despite it being less than previous weeks, I do expect us to have a risk for one more leg up in the stock market. Crucial test of equity sentiment as monster earnings await. And so companies I'm primarily interested in include Google on Tuesday. Then we have Microsoft on Wednesday. And then we have Amazon on Thursday. So I think those are probably the three most important. Amazon's quite likely to have some of the best earnings in their history from everyone running out to load up on supplies. But I think that companies like Facebook and Google might be a little more alarming, as they have to predict much less ad spend in the foreseeable future. And that could be dropping dramatically for those two companies. The totalitarian regime of China's President Xi Jinping now has more UN specialized agencies than any other country in the world. as they continue to feed money to the WHO. Southern European tourism, 21% of GDPs, is on its knees. Will it ever get back up again? Repo market is showing no takers, and that's because, again, the Fed's doing QE. The second the Fed ends QE, I expect we'll see repo measurements start to spike. Bank of Japan to increase corporate bond commercial paper purchases. So the real estate market's really at risk here. There's an interesting interview with Carl Icahn, who's shorting all the malls currently. He's made a fortune on that from last year. I guess one of the big risks for him would be Amazon coming and buying up all the malls. Crude oil swings. This is a record breaker and quite likely the only time in history you'll see oil prices go negative. That's why we jumped on it last Monday and remained long that position. State of the markets, fundamentals moving vertically to the downside, interventions moving vertically to the upside. Although I do think that's short-lived. Gravity can only be fought for so long. White House economic advisor Hassett, Q2 GDP will be the biggest negative number since the Great Depression, likely negative 20 to negative 30%. So all the data coming out this month will be the best for likely the year to come. S&P 500 is just 17% below its February record high, but the median stock trades 28% off its high. Narrow breadth can last for extended periods, but past episodes have signaled below average market returns and eventual momentum reversals. So we're seeing most of the stock markets now allocated into 5 huge companies, which again are the ones that we're watching present their earnings this week. Bill Gates says his foundation is abandoning other initiatives to focus 100% on the virus. That's really your heads up that this is not going away anytime soon. It's also interesting to see Microsoft remains one of the most valuable companies decade after decade. Not many companies can last in the top 5 for more than a decade, but Microsoft has done a great job at monopolizing its market and remaining at the top. And so this is probably the most important man to listen to, whether you like what he has to say or not. I do believe he will outpredict what happens next better than anyone else. Wave of repos imminent as subprime auto buyers miss payments. So the credit markets are really at risk. If we have 27 million people unemployed and counting, we have many businesses that will not survive. The big picture is that rent and payments are going to be missed, and anybody writing these loans are at great risk. Kyle Bast quotes Sun Tzu, "The whole secret lies in confusing the enemy so that he cannot fathom our real intent." China is not an enemy of the U.S. China wants to be friend of the U.S., a partner for the U.S. in fighting the virus. This is another Chinese propaganda Twitter account. It's quite odd that Twitter does continue to allow these guys to say whatever they want. Okay, Kyle Bass, the yuan is basically toilet paper and the new currency will be digital toilet paper. The basic architecture of their system needs to be fully understood. They have a closed capital account and need to beg, borrow, and steal US dollars simply to operate. So again, the big picture with China is they let money in, companies in, but they do not let the money or companies out. Our Twitter handle is @generatesincome. So you can follow that to see what I'm retweeting throughout the day. We like to think of ourselves as advanced and capable to solve any problems. We've made much progress, but this virus serves as a stark reminder that we are also very vulnerable. SARS, H1N1, bird flu, Ebola, AIDS, and now SARS-2 serves as reminders that nature doesn't stand still. Fact is, the explosion of our species on this planet has created a historic imbalance in favor of one species at the expense of all other species. Nature likes balance. With over 7.5 billion on the planet, we have become the supply, the largest potential food source. The damage is catastrophic. You have to have widespread bankruptcies because you'll have no revenue. By September, we will see some things economically return. The government will have to pick up the tab because this is an existential crisis. And he was talking about dropping their ad spend from 5 billion down to below 1 billion, which we should start to see in really Google's earnings, likely not this quarter, but next. Peter Schiff, how can a restaurant reopen at 50% capacity when the employees who don't come back will earn more than those who do? To be fair and to incentivize workers to return, they will need to be paid more, but higher labor costs will likely destroy any profits from a partial reopening. 26 million have filed for unemployment in the last month. The Federal CARES Act spent 2.2 trillion. That's more than 84,000 for every new unemployed. Enjoy your $1,200 checks, sheep. And this was funny. Trump was bashed for talking about UV light going into the body to fix the potential virus. And this, it turns out there is a biotech company developing this. I'll pull up the article. And Twitter suspended their account. So we're seeing pretty much any solution outside of a vaccine being shot down. So that's also interesting, and again, leading many people to create conspiracies as to what exactly Bill Gates is up to. Okay, Jim Bianco, we have to reopen the economy, and we have to do it responsibly. We cannot continue to sit at home and watch the economy crash into something worse than the Great Depression. And so we can see that the unemployment is, again, just something we've never seen in history. He further says, what are we waiting for? A vaccine? Conventional wisdom says 12 to 18 months away. But did you know that we have never developed a vaccine for any virus, coronavirus? It is very hard. You cannot cure the common cold. So we have to learn to adapt and adjust and live with the CV going through society. Otherwise, we will not have an economy. So between that and having all the riots happening about losing civil liberties, we can understand why the government, especially in a democracy, really has no choice but to open back the economy. Lockdown day 475. So they continue to tell us we're going to getting back to normal, but it always comes with all these catches, caveats, and again, is not really opening back up at full pace. Okay, let's take a quick break and review our different product options with Dean, and then we'll jump into a lot more information, guys.
All right. Thank you, Jason. Can you hear me okay?
Yes, sir. Perfect.
Okay, perfect. All right, folks, thank you so much for your time and taking a look at our new positions here today. And great job on the engineering there, Jason. Been pretty incredible to watch this drift up. And so I appreciate the trades today. Folks, there is a couple options for you. Okay, if you are a investor that wants some help navigating probably what's the most hellacious conditions we've ever had, that is the U.S. stock market. Okay, and I'm going to go ahead and post a URL into the chat box right now, so you guys can actually be directed over to this page. Okay, so make sure to copy and paste that URL that's at the very bottom. It says copy and paste this into your browser. Do so to go ahead and land on this page. Okay. Now, a couple options for you here, folks. If you have less than 30K, the buy and hold is the best option for you. Okay. If you have 30 to 70K, the basic option is beautiful, and that will utilize options. Okay. So buy and hold won't utilize options, but basic certainly will. Okay. And that's great for accounts 30 to 75K. Now, our most popular portfolio by far, and what certainly has the most capital behind it far and away, is the Pro portfolio. Okay, this is going to be just a phenomenal way, guys, to get the same type of returns that you're going to get from the most resilient hedge funds on the planet. Okay, we're extremely proud of the fact that 1% drawdown in a month is the largest drawdown period we've ever had since 2018. Okay, Jason just does a phenomenal job keeping our capital ultra safe at all times. Okay, and look forward to showing you how to do that as well. Okay, and something that you can literally build today. You saw the trade alert on the screen. You can take all your the high risk stuff you might have in the market, or if you're just in cash, it's going to be so much smarter, guys, to be in bonds, to be precious metals, and to dip your toes into the once in a lifetime opportunity here of actually having negative oil prices to really build some gains with. So like I said, guys, the Pro portfolio is really cool. If you have, a minimum of 70, but most of the clients following the Pro are using a couple tranches of 75,000. Okay, so some people are tranches of maybe 4 tranches of 75 to get to 300,000. And I think we have about 50 people using $1 million or more behind the Pro portfolio. And it's really cool, guys, because you're gonna have the same type of defense and really just consistency that you're going to get from someone like Stanley Druckenmiller or Ray Dalio. Okay, but you're not going to have to pay them the 20% performance fees. Okay, and also the 2% management fee. So let's just say on $1 million, guys, that you're looking to invest. Okay, it's really neat because let's just say you do right at 18% that we did last year. Okay, that'd be $180,000 in return. Your fee to us is $5,000 flat. If you're with, one of the best hedge funds, you're going to pay them a 2% management fee, which would be $20,000. Okay, and then let's say they make it 18%. They're then going to take 20% of that capital. Okay, so your total fees is going to be about $55,000 that they're going to subtract off the 180 that they would have made you. Okay, in our scenario, you just have that flat service fee, and it's really cool too, guys, because when you join either the Pro portfolio or the basic option today, you will get 30 days of the $10,000 boot camp at no cost. Okay. Now, if you're newer to trading and you really want to get the most education possible, the boot camp is a phenomenal way to really kind of go from a novice to a professional trader. Okay, and if you have a business, you can certainly write off the cost of that membership. Okay, within the business, and we have a lot of our clients that write off our service fee with their trading business or their investment business, or just with their normal business that they have established. So a couple options there, guys, and look forward to the privilege and the honor to help you all navigate these markets, profit from them, take your foundation that you have now and your capital structures that are in the markets, expanding those massively, okay, to then go back in and buy the markets once the blood is completely flooded in the streets. Okay, and it's time to get back in. We'll tell you when that area is too, but we're going to give you your risk off assets that are going to perform just phenomenal over the next 2 years or so. Okay, and then as opportunities present themselves, we'll certainly take advantage of those every single time we get the opportunity to do that. All right. So thank you, folks. Look forward to helping you all. And if you have any questions, just give me a call, 505-322-7515. I would love to help answer any questions you may have. And Boris asked if he could show the return. So yeah, Boris, it's on the screen for you, and thank you for that question. Appreciate it. And Jason, if you want to kind of click over the 1% drawdown and call Boris's attention and the rest of the group's attention to that, I think that would be greatly appreciated. So yeah, Boris, we've never had a drawdown period of a quarter ever. Okay, and we've had some really nasty drops. December of 2019 or December of 2018 when we started the program, the market actually dropped over 16%. We made 1.2%. Okay, February and March, the market was down between 33 and 34%. We made 6.2%. Okay, and we're profitable for the year, while literally every other investor on the planet, or about 99% of them, are down significantly. Most people I'm talking to are down currently about 20 to 35% for the year. So it's been fun to help our client base avoid that scenario and really profit from the current situation. Okay. And thank you very much, Boris, for those questions. All right, guys, other questions on the portfolios you can build with us, how it works. And so just real quick, guys, we're not going to manage your money. You're going to have full, complete control of your capital at all times. Okay, we're just going to do all of the hard work. We're going to watch the market 5 days a week, 18 hours a day. So you don't have to. All you have to do is just replicate our hard work with your account. And look forward to that honor and that privilege, and helping you all profit from this environment, show you what's smart to own, and help you and your families continue to grow wealth safely while the dumb money decimates their wealth.
Very good. Thank you so much, Dean. Yeah, Boris, so we gave up some of our profit this year getting set up for what I believe will be the biggest crash in our lifetime. And so we'll take a look at that. But I do want to point out the put options we're showing drawdown on currently have 2 years of time premium. So it's like I've paid for 2 years of life insurance. And so the drawdown we're seeing today is not really reflective of the real risk we've put into our portfolio this month. And so let's just take a look at the big picture and see if I can convince you that you're going to make more money shorting the stock market than anything else in 2020. So this is the major index. We're looking at really the European index in purple. Let's go back. So this is, if you guys have ever heard of a fellow named Jeffrey Gundlach, he's one of my favorites. And so I want to just take you through a little mini crash course in history of big indexes, which stock markets perform the best, and what happened when they did have overperformance. So if you guys remember the 80s, Japan was going to overtake the US. Tokyo was worth more than California. And you can see in the yellow line, the Nikkei was the best performing stock market in the 80s. But then what happened? Well, their real estate prices went sky high. The government took advantage of all the economic boom they had in their manufacturing sector. The government issued lots of debt, and slowly but surely the labor costs rose, the real estate costs rose. The government got bigger and bigger. There was plenty of fraud. And at the end of the day, all the companies jumped out of Japan and started looking for cheaper places to operate. In fact, funny enough, we'll see in the next big rally, actually 2 rallies into the future, that most of that business went to China. So Japan was faced with a big problem, and they chose to protect their currency and their bond market, but they allowed the stock market and real estate market to crash. So if you've heard of 3 lost decades for Japan, this is what they're talking about. And now Japan actually owns something like 2/3 of all the corporations. So the negative interest rate policy has not been very good for stocks. But again, they chose to really protect what they had and to turn their currency into their most valuable asset. And so today, the yen does remain a safe haven currency, and quite clearly what they use as leverage to gobble up assets all over the world. So they are the largest holder of U.S. treasuries as well as U.S. equities. But what happened? Well, their stock market tanked, and from the period of a high, you can see it lost 75% of its value, and that crash lasted 2 decades. Jason says we have SPY puts. Yes, we have SPY puts that are staggered at different expirations, Jack. And I'll be readjusting those likely this Friday. We do want to see what the Fed has to say this week, though, before we make any changes. So what happened next? Well, we had another big stock market boom, bubble, and the European index actually outperformed the US market in the dot-com bubble, which I don't think many people knew. The euro was going to be the ultimate savior of Europe. Combine all of Europe and you have a force bigger than the United States, similar picture that we were just talking about with Japan, but now with Europe. And their market actually outperformed the US index by a factor of 150%. That was short-lived. And so we can see what happened next. Their stock market tanked and again didn't recover for not just 1 decade, but 2 decades of bad returns for the European index. Coming into the housing bubble of 2008, the best performing asset was emerging markets. So we all think of, let's zoom in on this a little bit so we can see the magnitude of this rally. So here you go. US stock market went up perfectly fine during the 2008 mortgage collapse, but really where you got rich was betting on China or emerging markets. And so you can see the Chinese market outperforming by several 100% all other indexes. And what was China doing? Well, they were becoming a manufacturing hub for the world and expanding from 2 cities where you could go get cheap manufacturing. And they began just mass producing over these decades, huge skyscraper cities all over China. So the whole thing's built up now. But they ended up dramatically overbuilding to the point where they have tens of millions of condos that are not completed, cities the size of New York that are abandoned and just ghost cities. And so their market did not recover after that. So we can see 2 decades of returns then were dismal for emerging markets. And now we lead ourselves to the current bubble and quite likely the biggest in history. And so what we can see is the market outperforming everyone this time around by many magnitudes, several 100% greater than competing markets is the US market. So the big prediction is because of the massive debt that we're picking up at the government level and on the corporate level to try to keep this bubble maintained, that this is going to create bad returns for US equities for potentially decades to come. So that's a big picture of what's been happening in the different stock markets and which indexes have been the top performer in each decade. So again, my expectation is we're coming to an end of a cycle, and to put things really into context, we got to look at the most recent market crashes that everyone on this webinar has certainly lived through, which is the dot-com bubble and the mortgage crisis we had in 2008. So if we think about it, really, this 2008 crash was from subprime loans, which were about $300 billion in total that they leveraged into perhaps $3 trillion in derivatives. And then you got some AAA ratings on it, go fling that around into pension funds, and suddenly you had a huge problem on your hand, which again was that everybody on the underlying security wasn't paying their mortgage. In fact, it's something like a 25% delinquency rate. So once people started looking at these bonds and seeing that 25% were not paying their rent, that's when we had that crash. So what's happening today? Well, we're having a real estate crisis that's quite likely 10 to 100 times worse than what we had in 2008. Okay. And it's not just happening in the United States, it's happening globally. And unfortunately, this could very likely last for several years until there is a vaccine, that we're going to have limited capacity to run our economies. And so that's really the big picture here. My expectation is the S&P 500 will crash below the 2008 high, but not as low as the 2009 low. So I'm looking for a dramatic collapse that could be in length 1 to 2 years, which correlates with how long we've bought our put options. So that's really what's happening here, that the earnings of companies are going to collapse for a long period of time. And at the same time, the US debt levels are going to explode higher, as well as corporate debt, as they are selling every bond they can, firing every employee they can, and now going into a conservative mode to simply try to survive a very blurry future. We don't really know what the future will look like, although if it's anything like what we've seen in the past month, again, it's going to be horrifying economic data coming out. So that's what we're looking at to put things in perspective. This is a once in a lifetime opportunity to see such a substantial drop in the stock market. And that's why we have our positioning the way we currently do. Now, the next chart we're going to look at today compares the GDX ETF to emerging markets. So a lot of people buy gold in emerging markets for similar reasons, predicting a weaker dollar and, again, stronger growth overseas. And so we can see just how amazingly correlated the GDX ETF is to emerging markets. And so GDX can be used as a good leading indicator for what's happening in the stock market, as it moves much easier than bigger indexes do. Another great chart for us to examine is the QQQ compared to the cryptocurrency Ethereum. And so we're also seeing a high correlation of cryptocurrencies to stock markets. The same big players who are buying and selling stocks are also systematically buying and selling correlated assets. So we may see a huge drop in Ethereum well before we see the next big leg down in the stock market. So currently, we're not endorsing to buy cryptocurrencies because I do believe we are headed much lower. Here's our 20-year treasury, or rather 30-year treasury product. It's labeled 20-year. That's a common question people have. They just don't have a 20-year treasury at this point in time. So it's anything above 20 years, which means 30-year treasury. The big picture here is if you believe there's an acceleration of debt, the mechanism that allows them to sell that debt involves yields going down and the value of bonds rising. So our next short-term target to start pulling profits off the TLT will actually be jumping above the 180 level. Marlene says, do you believe we are headed lower even with the halving event on May 12th? Absolutely, yeah. I think crypto is going dramatically lower with stocks, and that they're not going to really stand a chance. It does not take a lot of selling to push that market lower. So probably the same expectation as a short term. I think we're going to see some pretty impressive moves to the upside as volatility index collapses. But that'll be short-lived as the bigger player, the Fed, is removing the quantitative easing. So that's really the big picture of what's going to drive markets. And so Friday, when they did announce that they're dropping it from 25 billion to 10, is great news. And if they drop that to 5 this Friday and maybe to 0 the week after, that will quite likely be the top. There's only a few bullish catalysts we have left. And then after that, there's really nothing to really be hopeful for stocks. So we have the opportunity to fix the oil crisis stateside, one. We have a potentially multi-trillion-dollar infrastructure project that, again, more like a steroid for the patient. The stock market's your patient. It has cancer. And you can give it a steroid, it'll feel better for a little bit, but it doesn't cure the disease. So really the only cure to fix the stock market is to get unemployment back to where it was in 2019 and to get all of the businesses back to fully operational. And that's just not in the cards this year, not in any resemblance of what we had last year. So it's quite easy to predict that profits and revenues are going to drop dramatically. Unemployment's going to remain high. And so when you have those economic conditions worldwide, you really don't want to be betting up on stocks for a very long period of time. And on top of that, we have the Fed removing the juice, which is not rate cuts. Rate cuts, again, nearly guarantee that the bond market goes up. It's quantitative easing that keeps the stock market rallying, and that's coming to an end. So that's really what is coming down the pipeline. The bigger picture is for us to sell the debt that the U.S. is issuing, we have to force money into the debt market. And so that's what I do see coming down the pipeline as really the big investment of 2020 will be the U.S. 30-year Treasury product. And I think that's going to be our lowest volatility, best returning asset class. Now for a quick hit, I love our USO play and I love shorting the volatility index. But again, I do believe we're getting near the end of the rope for that to pay off. Okay, in this chart, we're going to compare the S&P 500 to the TLT. And so the main point here is to note that every single time we've had the Fed cut rates to near zero, what happens? Well, they did it leading up to the 2000 crash. We had a stock market crash, bonds rallied. They did it again in 2008. What happened next was a massive stock market crash and a big rally in the TLT. 2015, you can see that China nearly collapsed the global markets, and we had another pop in the TLT, which you can see right here. And most recently, when we had a stock market pullback, the TLT also rose. So what's highly unusual right now, and really the biggest giveaway about what happens next, is that the TLT is doing the opposite of what it should be doing. So we're having this magnificent rally in stocks, which I would call a dead cat bounce. And I do think it could jump a little bit higher into this trading range right here. The TLT should be getting crushed, but it's just not happening. So because of the Fed doing rate cuts and QE back to back, the market has no clue what to do. So it's just all rising. I can tell you, to simplify your life, if you think that companies are going to have a growth of profits, buy stocks, and that's into the future. If you think that there's going to be a growth of debt, then you want to buy bonds. And what we're not interested is a fast speed. So if the government's going to spend $1 trillion a year at a flat rate, that's bullish for stocks. But if the government's going to accelerate debt and grow it from 1 trillion last year to 2 to 3 trillion this year, then you want to essentially bet on bonds and down on stocks, because that's going to drive money to the bond market. So my big expectation is real estate prices crash and stock market prices crash this year. And it does tug precious metals down with it. Roy says, what are your thoughts on the Rocket Man dying? Yeah, it's a big unknown, but I think that North Korea, they really have the boy who cried wolf. They go raise chaos until they get some money, and then they become quiet for a little while. So, and they're also controlled really by China. So we'll see what comes of that. I really have no deep insights into that, although it does look like the coronavirus did take out Kim Jong-un. Okay, so here's your correlation. And again, TLT should not be rising with the stock market. Every single time you have a healthy stock market, treasury yields rise. They don't drop. And so we're seeing these both go up. And so my insight is that the the people in the know are selling stocks to corporate buybacks and central banks loading up, and they're turning around and buying treasuries. And so that's why the TLT hasn't budged despite this massive rally in stocks. Okay, here's a look at our different competing bond markets. And we can see that the TLT right here is indicated by this black line. We're sitting at the 1.2 yield. My hope is to start pulling some profits on the TLT once this gets to a 1% yield. And then I'm going to expect somewhere around that area a bounce to higher yields and then drop much lower. At the same time, I do want to see the German yield go to negative territory. And as long as we have this spread right here, I'm going to continue forecasting lower and lower yields, which means the TLT can continue driving prices higher and higher. In the currency markets, oh, sorry, we're coming up to the currency markets in the next set of slides. In this chart, we're looking at FXI, and again, I do think we can get a crash that's similar to the 2009 low, which was in the mid 20s and potentially lower. So the situation for China has been deteriorating rapidly. And the big picture is countries are pulling out their manufacturing from China. So they're really in a lot of trouble here. So add on top of that geopolitical tensions between US and China, and they really have some rough times ahead. So whether we get this delisted and we get to walk away with the $31 per put, or if it just sells off in a systematic sell with the general markets, I really like our FXI puts. Here's a look at the yield curve. And as a reminder, the yield curve inverting historically has been quite a great indicator of a recession ahead. It did invert last year. It inverted again this year. The Fed reacted quickly, dropped rates to zero, did their best to make the yield curve look pretty. And that has been dragging the 30-year yield lower and lower. So again, that has been working like clockwork. We'll see what they announce this week. A surprise to me would be them pushing the federal fund rate even lower into negative territory. I don't think we're there yet, but who knows? They've been doing some pretty historic moves at the Fed level, really supporting every market under the sun. Now, I'm afraid I'm having some technical difficulties with my headset today, so I'm gonna go ahead and pull up the trade alert, review it one more time, do a last set of Q&A, and let everybody go today so I can fix my issue on the headset. But Tuesday, again, we will have a boot camp study guide out with a bunch of videos to watch. And then Wednesday, our next trading webinar. So let's just review head to toe our positioning and get any last questions out. So in general, the strategy is in the very short term, we're expecting some upside risk to protect ourselves against that. We have 4 big trades that represent small amounts of risk. So we have about 2% of our total portfolio at risk betting on the volatility index collapsing. So if this gets pushed dramatically lower, we can make several 100% return on these 2 put options. Now, again, if we're wrong and the VIX spikes, we're not too concerned because our bigger positions are bearish and will go up. We have the TLT position in the bond market. That's our biggest asset by far, especially when you add on top the set of call options. So if I had to bet all my money on a single trade, I would bet it on the bond market. And again, the calculation to be long the bond market is expecting a acceleration of debt, and not just debt we can pay for internally, but debt we're going to need to finance externally. We really need to sell this 3 trillion deficit this year to foreign investors as much as possible. So when you realize that, you're going to understand that the government is incentivized to create geopolitical tensions as it starts to really actually try to sell these debts. So last year we had about 1.3 trillion in deficits once you throw in all the hidden items. This year we were planning on a steady $1.1 trillion deficit, but with everything that's come up and been promised by the government so far, this will quite likely be in the $2 to $3 trillion range. So this is the fastest growth of the U.S. deficit in history. And you can predict it won't only be a deficit this year, but also a growing deficit next year. So again, if I only had one bet, it would be the TLT without question. And once we realize what the TLT will be doing to other markets, you can also figure out what will happen to the other markets. One fellow said, is there any changes for the basic when investing 30,000? Yeah, so you would be taking on the VXX put options today, but cut that in about half to have that. So again, it provides your hedge against upside risks. Okay, moving along, the next hedge we have is the GDX position. Now, GDX is highly correlated to stocks, so I do unfortunately believe this has great downside ahead. That's why we have the put option beneath it, protecting it. Marlene says, what are your thoughts about investing in the TLT put, but not the ETF? No, I wouldn't do that. The TLT call options, yeah, that would work out fine, Marlene, with a lot less risk. So yeah, I wouldn't mind you doing that. USO is one of the big catalysts that can give us a big push to the upside and is critical for our national security, is to remain energy independent. And so with the Saudis really flooding the world with oil right now, I really like this play. For this to pay off, we want, again, to see the American government come in and do some sort of bailout for U.S. oil drillers. And again, that can create a spike in the front month and at the same time keep the long-term outlook for oil bleak. And that's what will make USO pop. My hope is to get out of that between $7 to $10 a share. Currently, it's trading at $2.17. So we have a huge potential return. All three of these have put options below. So if we're off on anything, something unexpected happens, our put options protect us. Okay, I'm going to go ahead and wrap this up. Are there any last questions today before I let us go? I do have to get my headset fixed. I'm afraid it's giving me a little error message every 10 seconds. It makes it hard to present. David says, can you explain the USO position? Yeah, so David, you buy per $75,000. We're buying 2,000 shares of the USO ETF and then protecting it with 20 January 15, 2021 in the money 250 put options. So you're going to get your biggest loss possible the second you place this trade. And it's going to be the cost of your put minus that spread. So you got 33 cents in the money on your put. So take the cost of your put, reduce it by the 30 cents, and that's the biggest loss you can possibly have on this position. And what we're looking for is a bailout for the oil companies in the US that I do believe will create a spike on USO. So my target is in the $7 to $10 range. Marlene says, when do you anticipate it? I think sooner than later, because if they don't fix this, the market could crash just from this oil crisis. So if they don't fix it, USO will go to zero. The put will give you the full value of your put. And the rest of our portfolio will be shining. But I do anticipate they will bail this out. Julio says, it seems that you increased the text. So I didn't make any changes to the buy and hold portfolio, Julio. All I did was, the only edit I've made was changing the 6 to 1 because I, obviously can't tell you to do a 0.6. That did have the 10 to 1. So yeah, you shouldn't have made any changes to your buy and hold. The only change is to, if you do want to trade options, this is a good hedge for that with that. Jack, go ahead and write your question out for today because I am going to have to do some technical fixes on my side after we hop off here. Jack wants to know why I think the market's going to crash. Yeah, because we have 26 million people unemployed, and we're not going to be able to open up businesses for 1 to 2 years. Is really the big picture. And at the same time, we're rolling up QE. So yeah. Plus, you have the greatest deficit in history that's going to suck the life out of the markets. David says, are you going to place another TLT call option? Yeah, so I do anticipate this Friday optimizing our puts on the SPY, which are not a buy if you're a new member. So I am telling you to wait on that till Friday. And then I'll quite likely also optimize our TLT call options near that time, although I may wait another week for that. Mike wants to see the data from the Fed. Yeah, let me get you that link. So one sec, Mike, I'm pulling up that link. So here's the summary from their website right here. But in general, they have cut it from 15 billion per day down to from 25 the previous week. So from an initial 75 billion per day, when the Fed announced the launch of unlimited QE, the central bank first reduced its daily buying to 60 billion per day. Then 3 weeks ago announced another taper down to 50 billion per day, followed by a reduction to 30 billion per day. And then last week it was cut to 15 billion per day. Today it's now down to 10 billion per day. And at the same time, mortgage-backed securities have also been reduced. All right, guys, I'm really afraid I have to cut us early today. I did have a lot more content, but I'm having some technical issues. So we'll save this content for Wednesday. Let's just make sure we all have the trade squared away. Any last questions before I let us go a little early today?
Hey, Ram, I have your hand raised. Go ahead, bud.
Hey, Dean, so are we supposed to be placing those 200 put options on the VXX?
Yep, that's the trade alert today.
Okay.
So Jason, Ram just did the pro membership on Friday, just to kind of give you a background.
Yep. So guys, if it's the trade alert's pretty self-explanatory. It'll tell you whether it's a buy and hold. If it says buy and hold, you should have the position. And if it says don't buy, that means don't buy. And beyond that, that's really all you have to ascertain is if it says buy and hold, that's a buy for that day. So the new trade again was this right here.
Jason, and the other, the shares, the TLT and GDX, do we have to go ahead and make that purchase as well? Buys?
Yeah, so you really want to follow the full plan, Ram. So if it says buy and hold, that means that you should already have the position, and if you don't, you should build that position. So if I scroll through here, you can see these are a hold, don't buy. This is a hold, don't buy. This is a hold, don't buy. But everything else is a buy and hold. So you can build out, let's see how many total positions you can build out today. FXI, one position. Your USO puts is a second position. Your GDX puts are a third position. Your set of TLT call options is a fourth position. This you can wait until Friday. We're going to readjust this. Your VXX is a fifth position. Your QQQ call option is the next position. And then you have this set of ETFs. So in general, we're really positioned for a big drop with every put we have, as well as everything related to the TLT. In the short term, while we wait for what I expect to come down the pipeline, we have a few hedges that can deliver some pretty leveraged returns, which is USO, GDX, and then FXX and the QQQ call. Yeah, Craig, I would say you can put on the full portfolio, especially when interactive brokers will give you a little bit of margin for very cheap. So you could easily fill a 75,000 portfolio right now with 60,000 in interactive brokers. Okay, very good, guys. Well, we will be back here Wednesday. Really appreciate everybody's time. Right, Craig. Yeah. So if you wanted to have the extra, yeah, this whole portfolio will cost less than 60, so you could easily do it for sure. Sadish says he's unable to log into the webinar from his email link. I'm using a Mac. Yeah, that should work fine. So how did you end up on the webinar after all? You called Victor and got the link. Okay, we'll check into that. But yeah, the link should have worked from your.
Yeah, that's the exact same link.
Yeah, it is the same link. Forward your email to support, Sadish, and we'll test that link over here, okay? If you could forward us the link that didn't work to support.
Okay, yeah, and always a good idea, guys, to add support at portfoliobuilder.io to your to your contacts as well. That'll help the emails through here.
Okay, wonderful. Well, we will, Ram, do you have another question? Go ahead. Okay, great. Well, let's go ahead and wrap this up. Sorry for having a shorter webinar than normal, guys. I do have a lot of good content, but you're positioned, you're set to jet. If there's any upside movement, we're going to have some very, very high returns on these positions while we wait for the bigger plays to pan out. We'll see you guys on Wednesday. You'll get an update on all positions tomorrow as to whether or not there's anything to adjust, although I don't anticipate that. And if you're in the boot camp, look for a great set of videos to study tomorrow.